This discussion is brought to us from Pavol. We're going to talk about managing a should-be profitable debit spread. So we're going to look at a deep in-the-money debit spread that is currently not at a profit and is actually at a loss, even though it's going in the right direction. The initial discussion from Pavol by email was, how do we manage a bear put debit spread where the short put has a much higher implied volatility than the long one? Pavol's in a 147, 148 bear put debit spread. The stock's trading at 131. As of 1 o'clock this afternoon, it was at 130.25. So it's 11.3% in the money. I put out of the money. It's 11.3% in the money, exactly what we want for a successful bear put debit spread. Pavol goes on to say, however, the position is showing a total return or total loss of minus 550 in my brokerage account. And when I use the simulate trade and expected stock price on power options, if the stock moves up to 150, the profit and loss shows a loss of 14.90. This was a 10 contract spread with an 85-cent debit. So it was 850 risk with the potential to make $150. But the simulation, if the stock moved up to 150, say on Monday, was showing him a loss of 14.90, almost double of what he could potentially lose on the trade. He understood that this seems to be the result of a very high implied volatility on the short leg of the contract. Direct questions. How would I manage a spread like this? Clearly, I don't want to liquidate at 50% loss when the trade is going smoothly and going in my direction. But if the shares started to rise, how would I exit this trade before expiration if the losses along the way exceed my max loss at expiration? How would we deal the spreads with such different volatility? Before we get directly to that, let's take a look where we're at. The trade itself, January 19th, just 2 days ago, COUP was closed at 133.09. Pavol gave us the prices that he sold the 147 put for 12.45 and bought the 148 put for 13.30. That's our 85-cent net debit per contract. He did 10, so it was $850. As long as the stock stays below 147 on January 28th expiration, both puts would remain in the money. You could close either out or do the exercise assignment, essentially buy shares of stock at 147 and force someone to buy them at 148 based on the rights and obligations of the two options. We get $1 back. So the max profit is 15 cents against the 85-cent debit, 17.6% maximum return. And as we saw, we're still essentially 11% out of the money. So then what is the dilemma? Position is currently 11% in the money. I still think on credit spreads, Pavol. I apologize. So I kept writing out of the money. But we have 7 days to expiration. On the power options tools, we see it's currently at a liquidation loss. Not as bad as Pavol was saying, where he was seeing wide swings. And this was going to 3 times the maximum loss that is brokered, going up to $550, nearly 60% of the $850 he could lose. And at 1:40 p.m., linking from the portfolio view to the position analysis, we could see the close at market was a loss of $25. We'd only get $60 back if we went at market, so we'd lose $25 or $250. And at the midpoint, it was a little bit better. It was only a loss of $20 or $200 for the 10 contracts on the position. But why is this so much fluctuation with these deep in the money options? Well, there's a couple of reasons. You live by the sword, you die by the sword. Implied volatility. As COUP and the rest of the market over the past 6 days, even the past 2 days, has declined in Pavol's position, the implied volatility on both options increased. The 147 did increase by a larger jump than the 148. That's why he was having problems closing it. Because remember, Pavol would have to buy to close the 147. And as that implied volatility moved up, the extrinsic value actually increased, even though it was going a little bit deeper in the money. But then we also have another experience with the debit spreads. It's a little bit different than what we see with an out-of-the-money credit spread. As the options go deeper in the money, you tend to see a wider bid-ask spread. There's a little bit less activity in those options, and the bid-ask spreads start to increase. This is, as you mentioned, Pavol, it can become an issue with the debit spreads, making them harder to close, deeper in the money debit spreads, wider bid-ask spread position. Now let's get back into it. On the 19th, COUP closed at 133.09. The closing prices, different from Pavol's entry, were almost about the same in the sense that the prices were different. The midpoint of the January 147 was $14.95, but an entry at close still would have been an 85-cent net debit. But on January 19th, at the close, the 147 put was $14.95 with the stock at 133, a little bit less than $14 in the money. The IV was at 0.61. The option is $13.91 in the money, so that extra $1.04 is the time value. One day later, the stock drops to 131.80. It drops about 2 points, not even, it's $1.20. And the midpoint goes to 14.20. It actually decreases in value even though the stock went down. But the IV moved up to 73 in this case, and it still had $1 of extrinsic value. I think this is supposed to be 16.20. I apologize. I think that's supposed to be 16.20, not 14.20. But in any case, the time value did drop. It just didn't drop by that much. It's only been one day. It went from 104 down to $1. And current, as we got closer to the end of the day, the time value remaining was only 62 cents. So it's dropped about 40% of the time premium, that short option. Why am I focusing on that? Because this is the option we have to buy back, isn't it? This is the one we have to pay to buy back. We sold into $1.04 of time premium on that option. We want that time value, that extrinsic value, to go to zero when we go to buy it back to close out the debit spread. The 148 did lose as well. It went from about 89 to 65 cents. So that lost 24 cents of time premium, but you gained about 42 cents of time premium here. But again, that's at the midpoint. And when you entered the trade, the volatility was at 0.62. The very next day, it was at 0.7564 on the 20th, and it came back down a little bit. It was at 0.70 today, so that's fluctuating as well. What we're hoping for when you have the Bear Put Debit spread is the effect of the ATM bell curve, if you're right. You hear us talk about this for the radioactive trading position, but it essentially still applies to all other different options trades and option structures as well. What do we mean by that? When Pavol initially entered the trade, COUP was at 133, and we're maybe about this range, 17, 18 points in the money as a spread. And as the stock fell 3 points, we're now in this range. Okay, so we're going on the lower edge of the ATM bell curve, going deeper in the money where the time value is lower. The price should be reflecting mostly just intrinsic value and seeing the time value lower so you can buy it back closer to that $1 difference, 90 cents, 95 cents, to get near the maximum profit early. But we weren't seeing that. We were seeing the position at a loss. Sometimes he was seeing it at 2 or 3 times loss with the volatility fluctuations and more. The previous slide I just showed you with the loss on the position of about 17.6%, where we could only get about 70 cents back if we liquidated the spread today, even though it was deeper in the money, and it would have been a loss. We didn't get the 85 cents back on the position. That was at 1:40 in the afternoon. 20 minutes later, tracking this position in the portfolio, remember the closing values here gave us that 85-cent net debit, the same as Pavol got with different prices. The bid is about $1 apart here. Today at 2 p.m., the bid-ask spreads are $1.80. That 147 put had a $16.20 bid and an $18 ask, midpoint of $17.10. Oddly enough, the 148 had the same $1.80 bid-ask spread, but $17.20 to $19, with an $18.10 midpoint. If you can get the midpoint prices on that position, this would have been closed for full profit in 2 days. What you're likely seeing at your broker, although fluctuations in the bid-ask spread occur, Pavol, is the natural price of liquidation. The worst case scenario to potentially close the spread position, where they're showing you the values that if you bought to close the 147, you're paying an ask of $18. And if you sell to close the 148, they're showing the worst price, the bid, at $17.20. This is actually a debit to close. You're paying 80 cents to close this position. Between the two, you have to buy this at 18, sell this at 17.20. You're paying 80, and you already paid 85 into the debit, and that's a loss of 165, double of the maximum you thought you could have at expiration by paying the debit of 85 cents, or in your case, 850. This is the $1,650 loss. Similar to the loss you saw if the stock went up to 150 when you plugged it into the calculator tool with the current implied volatility. You never want to use a market order. You want to pay attention to the midpoint prices to see a better gauge of where your position stands or could stand, rather than worrying about having to fear to close it right now, looking at the natural prices and seeing a large loss on the position. The worst case scenario, selling at the bid, buying at the ask. You never want to use a market order when opening one of these spreads, debit or credit. You never want to use a market order when you're closing the spread. You want to try to put in your limits at the midpoint prices. Originally, when I came with this question and I went through it, I figured this was going to be a discussion about volatility. But when I started to go through it, I realized this is sort of a different conversation we're having here. And it's a conversation about patience. I know it's scary to see a large loss in your portfolio when you're looking at your brokerage account. I know sometimes it could be confusing when you say, I could have only lost 85 cents, the debit I paid in the position. How am I losing 165, twice the maximum risk? That doesn't make sense. It makes sense if you closed it and got the worst possible prices and let that happen. Again, that's why we use limit order. When I started this at 140, I was seeing some of the losses he was talking about here. That liquidation value would only be 70 cents. We needed it to be 85 cents to break even if we go to close the legs. Here, we would have had a loss of about $150 per 10 contracts, or $15 on the one contract trade, because we're only getting $70 back to liquidate. 20 minutes later, it was at a small profit at 2 p.m. The midpoints were showing almost full profit. And at the close, right before the close, 350 today, that same Bear Put Debit spread, the liquidation value was $1 at midpoint. For the full profit to be achieved, it was showing a midpoint price of $20.50 for the 148 option that we'd sell to close, and the buyback of $19.50 for the 147, the option we'd have to buy to close. We get the dollar back from that, and we'd be at full profit on the position. Patience. Spread trading, even shorter term spread trading of 5 days out, 10 days out, you want to have a little patience. We won't want to be concerned with the wild swings necessarily in the bid-ask prices, because as you mentioned, Pavol, it's still going in our direction. To answer your direct questions, how would I manage a spread like this? Probably don't like the answer, Pavol, and I apologize, but with patience. You know eventually the options will go intrinsic in a debit spread. You'll lose that time value. The natural liquidation might seem like a big loss, but we would never accept that anyway. You'd look to close the position at some type of limit that's closer to the midpoint. When you see your position having a large loss, look more at the midpoint prices rather than the natural. Is that a guarantee that you can get filled at those midpoint prices with these deep in the money debit spreads, bear or bull, when you have the wide bid-ask spreads? No, I'm not saying that. But you know the position is not as scary as a loss if you look at the midpoints rather than focusing on the natural. If the shares started to rise, say to 150, how would I exit this trade before expiration if the losses along the way exceeded my max loss at expiration? You wouldn't, okay? Even if both positions went out of the money, the stock rose above 150, both your options are out of the money. If your liquidation value you're seeing at that time is higher than the max loss, you wouldn't do it. You would just leave it open for the next 5 days through expiration, knowing they just expire worthless. All you'd lose is the 85 cents. If the stock did start to move up, what would happen? Well, we'd be going the opposite way of the ATM bell curve in the next couple days, wouldn't we? The stock would be getting closer to your 147 strike eventually, and you'd probably see a swelling of the extrinsic value. The option price would be going down. naturally, but you have less intrinsic value. You'd actually see the time value potentially swell if it happened on Monday or Tuesday, but then the time value decay kicks in and it would start lowering. But also, if the stock starts moving up, the implied volatility should settle down. The implied volatility is increasing because the stock's moving up and are moving down in price. But as the stock bottoms and starts to move back up or some good news comes out, you could expect the volatility to move down, which again would help reduce the extrinsic value of the buyback cost of your 147 put, as well, unfortunately, as the sell put on the 148 strike. How do we deal with spreads with such different volatility? Patiently, carefully. You entered a 9-day trade. Opened it on the 19th for the 28th of expiration. You should not expect to see a 20, 30, or 40% profit in 1 to 2 days necessarily. You need more time for that to go in your direction. You saw a decline down, I should say. You saw a decline downward since you got in the position. It closed at 128. But if you think about it, when you opened it, the stock was at around 133. It's only 5 points down on a $130 stock over the last 2 or 3 days. That's not really a big decline necessarily. Your options are getting deeper in the money, don't get me wrong. But it's not really a huge move from that position. You need the time value. Yes, even in a debit spread. A lot of people think that the time value only applies to a credit spread. But to close the position for near the maximum profit, the difference in the strike prices is what you want to achieve. You have to wait for the time value, the extrinsic value of those options to go closer to zero. It's still a time decay game, even though you're in a debit spread. That's what we need to do. I know it's not the best answer, Pavol, but you need patience with these positions. When it doesn't look right to liquidate because of wide bid-ask spread positions, wait. 20, 25 minutes. We went from a loss of 17% to almost potential to close at midpoint for near the full gain. And right at the end of the day, as the stock moved down further, down to 128, we saw that we were near 100% profit on the position if we could close at midpoint. It's still doing what we want. No guarantee we're going to get the midpoint. That's an issue with the debit spreads and the wide bid-ask spreads. But that's what you want to focus on. And then Pavol had another follow-up to that as well via email. COUP as well as my other two Bear Put Debit spreads continue to go down. The stocks are going in the right direction, but the profits have fluctuated up and down widely from 3 times the max profit to a huge loss within minutes. Fluctuating bid-ask spreads, changes in implied volatility, mostly the bid-ask spreads as it's going deeper in the money or bid and ask orders are coming in. And he says, clearly as the put's getting deeper in the money, the bid-ask spreads are getting too wide. This makes it impossible to close the trade for profit early. How do we manage this? Well, I think I've already answered that. You have to be patient. You can't expect to see a 40, 50% return on your debit spread, even though it's going the direction you want, in 1 or 2 days. In this case, it turned out to be 1 day and 4 hours, right? 1:40, 2 p.m. in the afternoon, we started to see that just get closer to intrinsic value where you could close it. Again, not saying it get filled at midpoint, but that is an issue with deep in the money debit spreads that you will come across. It's just the nature of trading. You know, something like Apple that's not as volatile as COUP might not have as wide a bid-ask spread with deep in the money puts or deep in the money calls. But as the market comes down, you're going to see those deeper in the money puts have a wider bid-ask spread. The reason for trading debit spreads appeals to many investors. Pavol wanted to trade debit spreads to avoid the situation when the shares trade between the strike prices. But it seems that Bear Put debits are perhaps not the best choice in down markets, and call spreads will work better. Well, of course, we're going to track that too. Might take a better look at it. But during the day, I didn't show this in the other slides, but during the day, here's your Bear Put debit spread. And this is at the close, 349. There's that 350 I'd mentioned before, 349.18. And it was near the midpoint, 2050, 1950. Of full profit on the position on that spread. But we know the bid-ask spread were probably $1.50 to $2. No guarantee we'd get these exact prices. But as they are going deeper in the money, you're getting there. I entered the Parity bear call. If we had opened the bear call by selling the 147 call and buying the higher strike 148 call on the 19th, the closing prices were 105, sell to open the 147, 90 to buy the 148. Net credit of 15 cents. That's the maximum return. Identical. 15-cent maximum profit with an 85-point risk, maximum risk on the position, 85 net debit with the max potential to make 15 cents or 17.6% return. These were true parity trades using the closing prices on the 19th. And this did a similar fluctuation. At the end of the day here, you see that it would cost us $5 to close the position. We'd have to buy to close the 147 at 55 and sell to close the 148 at 50. So it cost $5 to close it. We took in 15. We keep 10. So we make about 2/3 of what we expected to make on the position. Probably roughly a return of around, would that be 11%, roughly. Okay, so not the full 17%, but about 11% if we closed early. Throughout the day, when I checked these at different times, yes, we were seeing this bounce around from a loss of 17% to a gain of 5% to a loss of 8%, up and down as this price fluctuated. This stayed around a profit of $10, $7, $8, went to a loss of $5 at one point, the 3 or 4 times I checked them. Are the bid asks more manageable? In this case, yes. This one, when I last looked, the bid was 50, the ask was 60, so getting a 55 midpoint price, probably reasonable. This one was actually a 10, it was 40 to 60. Getting 50 might be tricky. If I put an order to close that at 50 with the bid at 40 and the ask of 60, I might see the market maker move instantly this number up to 50 because he's going to try to get me to close it at 55. Who knows? But that has happened to me before when I was trying to get in between the 10 cent, midpoint price. And as soon as I entered the midpoint, they moved the bid up to that price. And now he wants me to move from 50 cents to 55 to get the midpoint. And I say he was probably a computer at this time in any case. So is it a guarantee that I can get filled at these, even though they only have a 5 or 10 cent midpoint? No, it's no guarantee. But again, just like you, the spread is doing what I wanted. I'm seeing a near profit right now looking at the midpoint prices or a small loss, same as here, but implied volatility and being deeper in the money with the debit spreads, fluctuations in implied volatility, I should say, are going to change those prices up and down where you'll see shifts in the gain or loss due to the bid-ask spreads. It's just the nature of the debit spread trade and being deep in the money. Now, there's reminded me of something. I don't know if any of you remember this. Went to this actually back in 2007, 2008, I think. Options Express had that Options Expo out in Chicago. We actually had a presentation there. And I sat in on one of the lectures by one of the brokers from Brokers Express at the time. And he kind of made a quip during his comment. Instead of the play stupid games, win stupid prizes, at the expo during his speech, he said, play volatility trades, win or lose volatility prizes. And everyone got a little chuckle out of it. And I think I'd like to amend that to play volatility trades, learn volatile lessons. Deep in the money debit spreads, conservative. Parity trades to deep out of the money credit spreads. But they are going to have that fluctuation in the bid-ask spread being deeper in the money, $1, $2, maybe a $3 bid-ask spread, that if you see the natural price to close on your broker, you can see a loss that looks 2 to 3 times beyond what you thought the maximum loss would be. How do you manage that? You don't want to overtrade it and try to get out of the position because it's showing a loss. It's doing what you wanted. Eventually, the time value of those options is going to go to 0. The bid-ask spreads are going to narrow, and you're going to go to intrinsic value. And if it doesn't, if the bid-ask spreads stay extraordinarily wide, Pavol, even on Thursday before expiration, and the stock's still below your prices, you don't have to do anything. Yes, I know you'd like to get out of the position early for a profit, but unless the stock really fell 30, 25, maybe even 40%, you shouldn't expect to see a 50, 60, 70% profit on your debit spread in the first 2 days of trading. It would have to be more of a significant move downwards where you're just near to intrinsic value on both of the options. That's what we're looking for. And that's why I'm illustrating in this presentation, rather than getting in depth into implied volatility for your discussion, Pavol gives us a chance to illustrate the patience, even with these shorter 5, 10-day out trades. You don't want to panic if you see a bad loss on the position. If it's still doing what you want, it's still below both strike prices, give it the time, be patient, focus on the midpoint prices. No guarantee we'll get the midpoint prices. I'm with you on that, and that happens to me sometimes too. But I know that the trade is not that out of bounds and is not in reality that much of a loss, because I'm not going to settle for the natural prices. And if I just hold the position, we're going to get that time value decay in our favor to where those 2 in the money options are getting closer to the intrinsic value. We'll be able to close it for more near the maximum profit on the position. There's the closing price of the position. So this is another example. This is with the new bid-ask spread changes and the midpoint. This is not realistic. What are we looking at here? The COUP'd close 127.30. Midpoint prices probably went up a little bit, went wider, I should say, but we're looking at 20.90 versus 19.20. Okay, so that's telling us right now that we could get about $1.70 if we close this position at midpoint prices. No, we're not going to get that. You're not going to get that. You're going to get closer to $1 and closer to the maximum profit of 15. The bear call credit spread, hey, that got closer to full profit too, didn't it? It's about 83% of the 15 cents we'd expect to make. It costs us about 2.5 or 3 cents. Buy to close the 147 at 50, sell to close the 148 at 48, 2 to 3 cents roughly to close the position. So we still keep a profit of $13, 83% of the $15 we expected to make.